Welcome back to EDS, and in this video we're going to take a look at 3 strategies that you can use to grow a small trading account. And these are going to be options strategies, specifically selling options contracts. So the first strategy that we're going to look at is an iron condor. And an iron condor is basically just 2 credit spreads. Okay, so first thing we want to do is pull up a watch list that we can take a look at. So if you just go to just the default watch list, let's just say if we pull up GLD, take a look at GLD, and let's just say if we go 42 days out. So an iron condor, what's an iron condor? Well, it's basically 2 spreads. So what's a spread? Well, it's a short and a long contract. So let's say if we go short on the 20 delta on the put side, so we are now short the 223 strike on the put side, and then what we can do is we can then buy another contract further out of the money, and that would then make it a spread. So let's say if we just buy a contract that's say $2 out, this is now a spread. So we're short the 223 contract and we're long the 221 contract, right? This is called a spread, a credit spread, because we are taking in a credit up front. Okay, as you can see here, it only requires $168 in buying power. Perfect for small accounts. Okay, if you have got a bit, a larger account, you can allocate more to each portfolio. By all means, push the long side out. We increase the amount of buying power that's required, but we also increase the amount of premium we collect. We can just keep pushing it out until eventually we get to a naked position. So this is a spread. Okay, so we're going to go over iron condor. This is a spread. So to turn this now into an iron condor, we need to do the same thing, but on the other side, on the call side. So we will sell a contract at the 20 delta on the call side. The closest here, we've got 19 or 21. We'll just go with the 19. We could go with the 21. Why not? So we've got our short contract here at 244, and then we want to go $2 wide, so we buy another contract at 246. Oops, there we go. Buy another contract 246. So now what we've got here is an iron condor. Okay, this is a put credit spread on the put side and a call credit spread on the call side. Both of those together equals an iron condor. Now what this has done is, if you notice, without this side, we've got a credit of 32 cents, buying power requirement of $168. With this side, we double the amount of premium that we collect. However, our buying power stays the same. And the reason why is because it's impossible for price to breach our strikes on this side and also on this side at the same time. It cannot either be higher or lower. Your calls and your puts can't be breached at the same time. So you collect the premium off both sides up front, but your broker knows that you can't lose on both sides. So your buying power doesn't increase. It stays exactly the same. So this is why iron condors are really great and powerful for growing small accounts. You get a very high return on capital when it comes to selling iron condors. Just make sure that your position sizes are small, and we are going to go over how you can manage your position sizes, how you can work out your position sizes. So in a nutshell, that's how an iron condor works. By all means, you can play with the ranges. You can if you want to make this a bit wider, this is probably more closer to what you'd actually be putting on. You probably wouldn't go $2 wide unless if you really had to. You want to be about $5 wide. But that's an iron condor. That's the first strategy. The second strategy that we are going to take a look at is a strangle. Now you might be thinking, well, I thought you needed to have a lot of buying power tied up to sell strangles. Well, that is true, you do. However, you can sell some small strangles. So what do I mean by small strangles? Well, the first thing you need to do is you need to find some small underlyings. So just off the top of my head, because I was looking at this the other day, so let's say, for example, let's stick with the same example for now. GLD, right? GLD is trading at about $230, right? GLD is trading at about $230. So if we sell a 16 delta strangle in GLD, It's going to require $3,000 in buying power, which is not ideal for a small account. Okay, so what we want to do is we want to find a smaller underlying so we can sell a smaller strangle. So just remember, GLD is going to require $3,000 for a 16 delta strangle. Okay, so let's go to a smaller underlying. Let's go to BA, Boeing. We can go to the same strike, 16 delta. Boeing is trading at 107, which is a little bit less. So we go to 16 delta on this side, and then we can go to the 16. There is no 16 delta, so we have to go for the 18 delta, which is a bit more aggressive. But as you can see here, the the size of each contract is smaller, right? Because each contract controls 100 shares of the underlying, and each share for BA is trading at around $160, whereas with GLD it was around $230, and that's reflected in the buying power requirement here. For GLD it was around 3,000 something, and here it's 1.6k. So as you can see here, obviously BA has got a very high IV rank right now. IV is looking quite nice on it. The point here is that you can just sell a smaller strangle and it will require less money tied up in buying power. So let's go even further than that. Let's go and have a look at, let's have a look at Neo, right, which is trading at $4.84 right now. Okay, so let's look at Neo. For Neo, we don't have many strikes to choose from, so let's just go with the 25 delta on the call side and a 15 delta on the put side, right? I know it's not perfect, it's not ideal, but we are limited with strike selection here. The main point to highlight here is the size of the strangle, right? So each underlying share is trading at about $4.84, basically $5, which is a lot less than the two underlyings that we recently just looked at. However, if you look at the buying power required, it only requires $276 in buying power, which is far less than everything we've just looked at. Obviously, your premium is going to be less as well. However, the amount of buying power required is also a lot less. And the whole point of this example is just to simply show you that not all strangles have to require a lot of buying power. Sometimes it might make sense to place an iron condor, sometimes it might make sense to place a small strangle, but that will just depend on your portfolio and what's happening at the time. Now, the final strategy that we're going to take a look at is options on futures. Okay, so what we're going to do now is just pull up a futures watch list, and let's just pull up, say, the British pound. So the reason why we're looking at futures is because options on futures, the margin is calculated differently with futures. It's based on span margin, right? So the volatility of the product is also taken into account, your overall portfolio, everything else that's in your portfolio is also taken into account. And what that allows us to do is be far more capital efficient. Okay, so let's look at the British pound futures. Let's just go to November 8th. What we want to do is just get a baseline position mocked up here so we can compare it to something. So for example, let's just go with a 20 delta strangle at 19 delta on that side and then 21 delta on the put side. So as you can see here, we can collect $581 up front, and it will cost us 1.2k in buying power. So as you can already see, the return on capital is far greater with futures than with anything we've just looked at with equities, right? But let's just say 1.2k is still a bit too much for you. You want a position that requires less buying power. Well, let's take a look at what happens if we reduce our deltas. Okay, so if we go from a 20 delta, let's say, all the way down to a 10 delta, we can go to a 9 delta on this side, 9 delta on that side, so we've got 9 delta on both sides. Look what's happened to our buying power requirement. Our buying power requirements dropped, right? And this is because of the span margin. This is span margin taking effect here. So the amount of premium we collect up front is less, but also the amount of buying power required is less. So let's take it even further. Let's go down to, say, a 4 delta on either side. Now, even less buying power is required at just under $600. Of course, we collect less profit, less premium, sorry, but our buying power is less. Okay, our probability of profit is increasing, our buying power is reducing, and the reason why is the broker knows that the magnitude of something going wrong is going to be a lot less if you enter a position with a 4 delta as opposed to with the 20 delta. And that's why your buying power is different depending on which deltas you select. So I hope this video was really insightful. That's 3 strategies for you: iron condors, small strangles, and then strangles on futures. You can also sell iron condors on futures, but because it's so capital efficient, I personally wouldn't. Just stick with the strangles. The only final thing that you need to know to be able to make this work is you need to keep your position sizing in check. Okay, now we have a position sizing template that we've put together. The way it works is you just put in the size of your portfolio. Let's say if it's $5,000, and let's say if the VIX is currently at 35. What will then happen is everything below will be automatically calculated for you once you've entered in these 2 cells, and everything below will tell you how you need to structure your portfolio, how much money you need to allocate to each undefined risk position, each defined risk position, how much of your portfolio to allocate to short premium strategies in general, and of course, you've got an explanation of everything underneath. Now, I do want to mention EDS Premium to you. So inside EDS Premium, you will of course get the position sizing template, but you will also get access to all of our portfolios, small and large, so you can emulate our positions in your own portfolio. We also have a full course that will take you from knowing nothing to being an expert, so you can learn and earn at the same time. Of course, it's a private membership community in Discord, so you can speak with other like-minded traders, get advice, get help. You can speak to myself directly. Um, there is also a 100% money back guarantee. So if you've studied our full course and followed our trades for 6 months and you haven't been profitable, then we will work with you for free until you are profitable, or you can request a full refund. So it's completely risk-free from your part. Right now, the price is £1 a month. The price will be increasing for every 5 members that join. Whatever price you get in at, that is the price you are locked in at. So you will never have to worry about any price increases. You are locked in at the price you get in at. So with that being said, I'll see you guys on the inside.